Good. Well, socials get started. Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Hey, Kirk, how's it going today?
Doing great. Doing great.
Good.
Actually, get some reasonably nice weather after our 40-degree spell here. It's typical New England spring, anywhere between 80 and 40.
Same in Minnesota. As a matter of fact, I'm really excited because this is our Scouts annual trout fishing trip, and that's to southeast Minnesota, and it can be hit or miss. 2 years ago, it was really nice. Last year, every kid was turning blue as we woke up, and it was in the mid-20s, and frost was on everything. And then, of course, the last thing you want to do is start going and putting your hand in water. So this year it looked like it was going to be a rough weekend, and then as the weeks progressed, we saw highs move from like the 40s now to the 60s. So I'm feeling really good to get away for trout opener and enjoy this weekend. And that's anybody listening, time with the kids. You can't. Time is something you never get back, so it's always fun.
That's true. That's true. You got two kids. They're in high school. My youngest in high school next year, and a few more years, they'll be off to college and probably never see them again. So we're trying to enjoy as much as possible the time we have with them. And even when they go off, I remember when I was younger, my parents, would take me on trips. They were like, "Oh, we should go over to Europe." I'm like, "Okay, free trip, sure." But it's like the only way they would hang out with them because, at a certain time, you just want to do your thing. And so, yeah, we're trying to take advantage of that while we can because we're getting a little, it's getting a little weird. Like, what are we going to do with ourselves? We have to come up with a hobby,
That's right.
But yeah, so it's been it's been an interesting week as the last 6, I guess, at this point have been. The war is still not war is still going on, not going on. Every day is an adventure. We had a surprise on Thursday night, Wednesday night, going into Thursday, where the markets dropped really quickly because there was some news out that there was some missiles being fired back and forth, and then the reports came back and said no, that was just they were just doing training missions. Like, oh, so in the middle of a war where there's a ceasefire, doing training missions where there's a bunch of firing going on. That's a good idea. That's a really, really smart idea. Glad they thought of that.
Whoever was working the spin on that one probably should have done a little more work on figuring out if that was the best thing to put out there. I mean, I feel like that could have been handled better. Yeah, training mission, sure.
I mean, there's so many people. I mean, it was actually a reasonable excuse. I believe it. I don't know if it's true, but I believe it. It's like, okay, everyone kind of agrees that's it. And then the markets went back up. Yesterday was a rough day in the markets. Today is fine. We're in this place where I just kind of want to talk this through because we talked it through a few weeks ago before we get into some specifics. When you think of investing, you have to think of the world in terms of frameworks, right? That's because we as human beings are not good at all at predicting the future. We all do it. Our brains operate like a prediction engine. We all try to predict the future, and we're terrible at it. All of us are terrible at it because if you're good at it, you'd be a bazillionaire. But we can't predict the future. So, but our brains naturally go there. So rather than trying to predict the future, a better way to handle it is to look at the world in terms of frameworks. If this is true, then this other thing should be true, right? The problem is, so typically when I do investing, I look at frameworks. If you look at pre-war, so there's like a pre-war framework, I guess you can call it like a great rotation, because the markets were rotating. It was normal. People didn't like it because tech wasn't doing well, but everything else was fine. Typically, the markets through economic cycles will rotate. They rotate from one area to the next area. That's healthy. And that's exactly what was happening in pretty much the end of the year towards end of February. Things that were doing well: energy, industrials, value. You had materials, you had staples, utilities. A lot of areas are doing well. You're like, what are those areas? But those areas are doing well in that kind of first component, the great rotation, as some people call it. The things that didn't do well were, consumer discretionary, technology, growth. Then you look at, and I'm actually just going to share this. It might be easier. There we go. So, if you look at it that way, that's one framework, right, as to how the world works. The markets are rotating. They're rotating away from tech and into staples and other like safer areas. They're rotating into bonds, all very normal stuff. And then the war happens. And then everything goes out the window, where, with exception of energy, which kept going higher, everything else declined. So all the areas that are doing well went down. Now, did anything change? Not really. But when war happens, everybody just sells everything and just moves on. So as you can see, from the end of February to the end of March, energy did well. Everything else did not. And then pretty much starting the end of March, you had what they call like the chase, which is people are chasing the markets higher. Now, I'll kind of explain this a little bit. In the first framework, when things were rotating, they were normal. People had a allocation that they were happy with. When the war happened, people had to throw that out the window and get rid of that allocation, sell a bunch of stuff, get short the market, all the things people were doing to position for this new framework. The end of March, the framework changed again, and people are like, oh crap, now I'm behind. I'm short in the market where I really want to be super long. I want to be in tech. I want to be in all these things. And the market shot up more. I don't know if it's the highest it's ever been in recent history, but it's, if not the highest, it's one of the highest in recent history. The other times have been when the market bottoms. This time was 9% from the top. I wouldn't call that a market bottom. We're talking to like 2009 in March. We're talking about March in 2020. Like, those are market bottoms where things shot up. Okay, I get it, right? Sold off a lot, comes back a lot. We're pretty much at all-time highs. And we had this, and the reason is because people were naturally moved to a bearish bent in scenario 2. They went to this bearish bent where normally bonds should do well, but they weren't. Prior to that, they were. And then with the war, bonds didn't do well. Now, the reason is because people thought inflation would come, and that would mean interest rates would be higher. So bonds sold off. So pretty much everything sold off except for energy. Now, you look at the chase market, people were behind. So people sold their energy and they sold other things that they were in before shorting the market, and they started to go long. So what did well? Growth did well, tech did well, discretionary, things like that did well within a really, really short period of time. Now, you look here, it's like, oh, the S&P was up, 12.5%. Well, the total return for the year is up only a few percent. So it was down and it's up. But the thing to keep in mind is this. Everyone got caught in the wrong direction. So if you think of the investing world as like the Titanic, right? All the investors are on the Titanic. It's going in one direction. Now, if you're changing from scenario 1 to scenario 2, well, that Titanic's got to make a beeline. You got like a sharp turn all the way around. That doesn't happen. It takes a while. It doesn't just, it's not like a quick, nimble ship. It has to go slowly over time. So pretty much that last month, slowly the markets turned and started to go negative. And then once Trump's like, hey, the war's over, even though it's not over, all of a sudden you had to do you had to have the big turn again all the way around. Well, the problem is everybody's chasing the market higher because they don't want to lose out on that return. It's a psychological game. It's a problem. Everyone should know that this is happening, because if you don't know what's happening, it's going to really screw with your head. You're like, oh my God, I'm down for the year, blah, 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 blah. Okay, just relax. The markets have not taken off. Yes, they hit all-time highs, but I wouldn't say that it's something to be proud of. Basically, a lot of people got caught, and now they went the other way. And now people are more or less positioned in where they have to be. So now the question is, where is the next framework? Where's scenario 4? Now, we don't see it yet. We don't know what it is, right? We're guessing where it is. At the moment, like 2 weeks ago, we told you to exercise patience and caution. This is why. Because right now, you're either caught chasing the market higher, which maybe, I think it's a little too late to do that because it's been going on for 3 weeks. So I think you kind of missed it. You can either chase it higher, or you can wait and see if this chase higher is confirmed with continuous movements up. We're not at that point yet. A lot of people are trying to get positioned because they missed it. Well, if we are still in a bear market and I use the bear market in air quotes because it's not technically a bear market, but if you're in that bear market kind of framework, right, which is scenario 2 with the war market, if that's still the case, you can frequently see things like this. You can see a massive sell-off, a massive bounce back, and you can see it go down again. We saw this in 2007. So in 2007, in August, the market sold off 10%. People were freaking out. Market sold off. And then from that point until the rest of the year, the market not only came back, but went higher. That was the peak before 2008, where the markets lost 58.5% for the S&P. So don't be fooled by the fact that the market shot higher and everything's fine again. It might be. I'm not willing to make a bet on that yet. I have to, personally as an investor, I have to look at the data and say, all right, where are we? Is this a fake out? Is there confirmation that things are going higher? Or, or is there, now, we don't know what's going on with the war right now because every day is an adventure, right? We had that misfire, the training exercises, and then, another day, there's an indefinite ceasefire. Maybe we're going to blockade them for the next 5 years. I don't know. I don't know what's going on. Trump is certainly not giving us the skinny on it. So we have to guess. And at the moment, we don't even know what he's doing or why. Maybe he's going to wait him out, which is a strategy. He waits him out and just says, all right, we're just going to blockade you until you give up because you're not going to have any money. That's a strategy, right? I don't know if it's a good strategy if he wants to maintain power in the midterms, but hey, it's a strategy. It can work. That will disrupt the global economy beyond our borders. So in that scenario, I would not be a fan of investing in international stocks. I think they're going to get hit hard if that's the case, especially emerging markets, because we talked about this a few weeks ago. They're already hurting. It get worse. So how do you invest right now? Patience and caution. Don't jump on the market just because it's going higher. Be patient. Maybe take a small position in something. Start. If your full position is 5%, maybe put 1% in. Start there. See if you're right. If it keeps going higher, okay, at least you have something and you can keep adding to it. But if it goes lower, well, you don't have that much exposure and you're not going to get hurt that much. But that's how you should be thinking about the markets, is slow and steady, patience and caution. Take your time. Don't get, over eager because you're missing out. It is April. Now, if you're trying to chase the last returns in November, okay, I get it. If you feel like you're behind, that's what a lot of people in the markets do. It's April. A lot can happen between now and elections and now and the end of the year. A lot can happen. I expect Q4 will probably be a very good quarter. Until then, I expect a lot of volatility. And if we see the markets continue to shoot higher, I would be shocked. They could, but that's not my base case. My base case is we're going to be chopping around here all year until around October, and then we might see some upside. But until then, I expect a lot of chop. And I've told my clients such, that you expect a lot of chop. Don't even look at your statements. It's just going to be choppy. It's going to be up and down and around, and we're not going to make much progress. It's just the way it's going to be. So you have to, if that's the case, then you have to think about, all right, how would I invest for that? So there's nothing wrong with sitting on the sidelines and waiting. If you're concerned, sit in cash. Who cares? So you miss a few percentage points. Not the end of the world. It's better than losing, 5-10%. So that's how you want to be thinking about these markets. And that's why, this chart was really helpful in that it helps to put a picture to what we've been talking about for the last few weeks, which is look at the different scenarios, be patient, because there are a few scenarios. I would say great rotation most likely will be, that's if things start up, I think most likely that would be where I would go with this once the war is more or less wrapped up. We're like 99% sure it's wrapped up, not just what Trump's saying, but actually being wrapped up. I would say going back to scenario 1 is probably the most probable, but that's not what the market's doing. The market's chasing tech. I don't know why, but it's chasing tech right now. So you have to be mindful of these rotations that are happening. These are quicker rotations than I've seen in a long time, and we could have more. So just be prepared for that. Either be prepared for volatile markets, be prepared for a rocky ride, be prepared for sitting on the sidelines, whatever you feel like you need to do. But just understand that this is how a lot of institutional money managers are thinking. This is how we think. is how a lot of people are thinking. You can't just assume that things are going to go higher and we need to buy tech because it's cheap. That's not a great strategy. It didn't work prior to this, and I suspect that it's for the foreseeable future with standing semis. Tech's not doing a whole lot. There's other areas that are. You can look at other areas. It doesn't have to be tech all the time. So I don't know. What are your thoughts, Doug?
Yeah. So, well, a couple of things. I mean, I think one of the things that we're facing right now that has to be taken into consideration is that we are seeing that overall economic activity has started to slow. However, but what we are also seeing is at the same time, the markets have rallied on deal optimism, but real time economic data is softening. Manufacturing weakening again, services slowing, business expectations are declining. The markets have rallied on hope, but the business activity is starting to show that, as we look further out, forward-looking markets are going to meet real-time slowdown. Now, let's take a current reality check. We talked about this last week. Earnings season. The S&P 500 as of and again, there's been a little bit of a shift here in the timing since then, but as of April 17th, so this was a week ago. At that point, we had about 10% of the companies reporting actual results for Q1. Of those companies, 88% reported actual earnings per share above estimates. That's above the 5-year average of 78% and above the 10-year average of 76%. In aggregate, companies are reporting earnings that are about 10 to 11% above estimates, which is above that 5-year average of 7.3 significantly, and over 3% above it, and above the 10-year average of 7.1. So, they're coming in significant. Now, I don't have the data on this, but we know that there was, of course, increases in pricing due to the tariffs. There's been refunds of the tariffs. We all know that we're not getting refunds on what we paid at that point, which is creating controversy because these companies have kept that, and there's no real metric to pay us back on a tax that no longer exists. So that certainly could be playing into driving some of these profits up, which if you're a cynic, these results, I think, are feeding into your cynicism of, hey, let's take bad news, let's capitalize on it, let's pass the prices, and then ultimately increase our profitability. So during the past week, positive EPS surprises reported by companies in financials and communication sectors. Again, now we're looking about 2 weeks ago from this data. Were partially offset by downward revisions to EPS estimates for companies in energy. Those are the largest contributors to the increase in overall earnings growth of the index during that period. Ultimately, when we take a look at revenues, 84% of the S&P 5 companies actually reported revenues above estimates, which also is above the 5-year average of 70% and 10-year average of 67%. So we said this a week ago, the data coming in being reported by companies in this cycle probably and are showing, at that time we said probably, now they are definitely showing to be, quite positive because again, these positive surprise are coming from the fact that again, everything's a lag, right? So we're not seeing the impacts of what might be happening with a downturn of the economy, the downturn of the middle class, the pressure that might be felt, because of the war in Asia and Europe and places like that. We're not feeling it yet. We're still seeing the results probably of higher increases of revenues and profits based off maybe what we saw 2 quarters ago with and 1 to 2 quarters ago with tariff increases, again being something that now companies have an opportunity to capitalize. So right now we are definitely, where are we seeing S&P 500 earnings growth? Consumers, commercial services, 100% above. Healthcare, 100% above. Info technology, 100% above. Materials, real estate, all 100% above. Now, financials, 95% were above, still very positive. The S&P as a whole, as I said, 88%. Consumer discretionary, 80% were above. Where they were seeing some pressure of estimates, where they were more misses, consumer staples. 33% of consumer staples companies were coming in as a below estimates. Industrials, nobody really missed. They were 67% were above. So again, the majority of the companies reporting, the biggest areas, that were showing misses were consumer staples. Now, on S&P, that was on earnings. Now on revenues, this is where it gets a little bit different. We saw we did see consumer discretionary 20% below with 80% above, but on the revenue side of things, 40%, the worst area reporting was consumer discretionary. That came in at 40% below with 60% above on revenues. So their revenues were missing, but their profits were still overwhelmingly exceeding. Financials, again, with 95% hitting on the earnings, 73% were above on revenues. So in some areas, some of the ones that were more profitable, we still saw some softening of revenues that kind of tied into that. So they were able to make more on less coming through. But where we're still seeing the same, both whether or not revenues or earnings, again, services, consumer, healthcare, industrials, information technology, materials, real estate. Interestingly enough, consumer staples were 32 or 33% missed on earnings. Alternately, on revenues, 100% of them were above their expectations on revenues. So again, they were still selling, but there was pressure for whatever reason on their revenues. So right now, again, things are really going to, seemingly going to continue to be positive. That's, what do we do? How do markets react? They react on the news that comes out right now. They don't do a really good job, as you mentioned, the predictions. They don't do a really good job of planning for what the future is. They are reacting to the news that's coming out now. They're reacting to the news that the war might be softening, although now, again, as soon as they opened the Strait of Hormuz, they closed it again, right? So we said this last week. We're in the middle of a war. You got to be patient with the news that's going to come out. Then you take a look ahead, and you also start to look at, again, a midterm election cycle. You mentioned it, Kirk, choppy. Historically, midterm election cycles are one of the choppiest years that you run into of any years within the markets. Now, what does that mean for the years following midterm elections? Those years typically do well. But, if we look at data up to this point, 6 consecutive quarters of significantly surpassing expectations, 6 consecutive quarters of growth. Again, we're still kind of feeding off the hog there of what was happening before. And I think now, when we take a look at the war that we've been in, the uncertainty of the midterm elections, we said it last week, getting through this quarter, not a problem. But going into later second quarter, third quarter, fourth quarter, it's definitely a time to maybe think, hey, thank God it came back, but should I start to be in a place of putting in fail safes, putting in some caution? Because again, it may hurt worse to give it back than it is to miss out on maybe a little more growth that might happen in the next 2 quarters.
Yeah, no, I think it's important, and I'm going to bring up some charts here to kind of walk through this week, because I think it's important just to kind of get some context. So this week we had a number of companies report, and I'll kind of run through big hits and misses really quick, just to give you some perspective on what's going on in the markets. So if you look at like airlines, you had Southwest report was not good. You had Alaska Air reported not good. You had 3M report, and that was not good. You had, let's see, I'm going to pull these out. United, that was not great. GE Verona That was great. I think that was up like in the double digits return on those earnings. So obviously that, with the gas turbines and whatnot, that obviously did well with the war. So that was good. That was a positive. We had Boeing that came out. That was pretty positive. You had AT&T. It was, I would say, mixed. It was slightly negative, but it's kind of right around the same place. IBM was hugely negative yesterday, and that was really ugly. It was down double digits. You had Tesla also not great with earnings. You had Intel come out after the close yesterday. That rocketed. That was up. I think it shot up from like the high 60s into like a high of 85. So that huge day. I think it's up almost 22% right now. You got Newmont, which is mining, that did well. Baker Hughes, what's that? BKR. That did well. Obviously, with the war, that did well. American Express, I was surprised that didn't do well. Mostly the financials have been doing well. American Express sold off, so that didn't look good. And then AAL, is that what it is? I always forget that. American Airlines. Yeah. So and then Procter and Gamble was today. That was good. So I just ran through some bigger companies, and there's some more. There's HCA. That was not good. So I just ran through some of the bigger companies, not all of them, but a number of them. And there's some other ones in there I didn't really discuss because they were kind of non-starters. Like Boston Scientific was up, not huge, but I think it's where it started. So there's a bunch of them in there. I would say the notable ones are the ones I talked about. So what does that say for you? Well, this week's been more or less neutral in the markets. It's bounced around a lot, but it hasn't really gone anywhere. If you look at the sectors, industrials have been more or less flat. Energy has come up a little bit, not enormously, but I guess over the last week it's been up. Financials have been down this past week. Materials have been sideways. You have staples have been up a little bit. Utilities have been up a little bit. It's more or less flat. Healthcare is not done well at all. Healthcare has been ugly. And then you have technology, which obviously mostly is driving the market. Technology did well, and discretionaries were kind of more or less flat. So, based on, I just went through the main sectors, right? And the one that's driving it is more or less technology. Like everything else is just kind of sitting around. I've noticed this the last few weeks when those markets are taking off. Like not all the sectors are taking off. Some have actually not done well at all. I mean, healthcare has just been ugly. Everybody hates healthcare right now. Healthcare has not been doing well at all. So, if you look at these sectors, and this takes it back to the framework we talked about before, you have this framework of the markets, or a handful of frameworks of the markets, and one of these is going to win. Well, we don't know yet because right now, with exception of tech, everything else is just kind of not doing much. That's why there's not a lot of interest in getting in. Now, if I look at, I'm going to share a few other things that I think are also notable in the markets, and one is correlations. So I saw this and I thought it was worth sharing. So the markets over many, many decades, they tend to have certain correlations. The correlations tend to be sticky until there's a paradigm shift or something that caused the change to be a little bit more permanent. Now, there are times in the markets that this is going back 20 years. So if you look back 20 years, there's a inverse relationship between stocks and bonds of negative 0.5, which is pretty good for stocks and bonds, which means when stocks go up, bonds go down. When stocks go down, bonds go up. It's an inverse relationship. And that's how most people have their portfolios. The problem is starting in 2022, when interest rates went up and stocks went down, it means the price of everything went down. And since then, now we're at a positive 0.5, which means when stocks go up, bond prices go up. When stocks go down, bond prices go down. That's a weird thing to consider. So what's the point of diversification? It doesn't work. If you have a 60-40, it's not working for you. It's not doing anything for you. Because the whole point of a 60-40 is to diversify and reduce your volatility. It's not reducing risk, it's reducing volatility. It's supposed to do that. It's not doing it, according to this. So when you think about how you're investing, are you investing in the typical 60-40? Are you doing your 8 or 9 different funds? You spread them around and diversify? That's not working, according to this, because everything's correlating. So you have to rethink how you are doing your allocations. You have to rethink, why do I have bonds in there? Bonds aren't necessarily safe. When you lost 50% of your money being in 30-year treasuries in 2022, I wouldn't call that safe. So there are times where it's safe and there's times where it's not safe. But what's most important is thinking through why you are doing things. Don't just do things because your cousin's brother's former roommate is doing it. Do it because it makes some logical sense. Now, the next one I want to share is another relative chart, just to kind of give you some perspective on the markets right now. So if you look here, what you'll see is right around September, October, the technology stocks stopped outperforming, started going sideways for a while. And that's right around here, right? You got a high PE in the 30s, and then it started to drop. Well, it dropped because these companies continue to grow, many of them, but the stock price didn't go up. Now you get to a point of pretty much this month where it got down to 20 or 21, 22, depending on which day this came out, in the low 20s. Well, that's a lot better than the 30s. I wouldn't say it was a bargain, but comparatively over the last 5 years, it's a bargain. So should you invest in tech? Don't know. I don't think the fundamentals of tech have changed just because a war happened. Maybe that's me. Maybe I'm crazy. But if you're worried about AI eating software's lunch, then this is still sky high. I mean, tech should be 50% lower if that's your thesis. If you think that AI is going to destroy software, software is way too expensive right now. That's why software hasn't bounced back with the rest of tech, because people are still assuming that AI is going to eat its lunch. I'm a little more skeptical. I don't know if that's going to happen. I suspect if it does, it'll happen over very long periods of time. And I suspect that these companies will integrate AI anyway, so they'll still be around. That's my assumption, but I'm not betting on this. So just because there's a game plan doesn't mean you have to play. So I'm just curious looking at this. And so I find it to be a useful lens to look at tech. Here's another one. So here's something you should, if you're investing in tech, especially the Mag 7, here's something you should keep in mind. Now this is, we call it CapEx. So this is the amount of money they're spending. So historically, big tech has not had a lot of capital expenditures because they don't need it. It's a very scalable model. They generate a lot of cash and they don't have a lot of expenses. Up until right around when AI started to pick up, and now you see that the CapEx starts to pick up, 24, 25, 26. All of a sudden things start to pick up. Amazon, that's a little more labor, a little higher CapEx anyway, although that's been increasing, but it was always a bit high. But if you look at these others, you look at Microsoft, it was always really low, which is one of the things I liked about it, is they didn't have a lot of CapEx. But now it's grown like a weed. What are they getting in return for that? From what I'm seeing, not much. People are not buying their Copilot, and AI is not going well for Microsoft, to my understanding. You look at Meta. Meta's increased a lot. Wow, look at that CapEx. What's Meta doing? I don't know. They stopped the metaverse. Like, what are they spending it on? Government black op programs? I don't know. Like, I'm not seeing any of this. They say they're coming out with an AI, but they haven't done it yet. So I have no idea what it's going towards. Alphabet, I guess they're doing a lot of data centers because they got Gemini. So I'm going to assume that's what's going towards. Amazon's increased quite a bit. And then you got Oracle. Well, probably shouldn't have been in there. But anyway, so if you look at these tech, like these hyperscalers, CapEx just keeps going higher. So where does that end? Does it go higher forever? Does it stop? Like, where's the point they're going to stop? Like, there is a point where technology companies, especially Mag 7, are no longer attractive as investments. If you keep spending all your free cash flow on CapEx that doesn't return you any profit or very little profit, if you spend $100 to get $100 in profit, that's not a good investment. Not for these companies, but that's what they're doing. So are they a good investment? I don't know. I think people reacted to the markets and just put it in tech. I don't like them. I think individually here and there might be some good companies, but in general, I'm not attracted to the Mag 7. I don't see them. If they stop doing this, I would be a fan. But the fact they're spending all this money, they're spending my money as an investor doing stuff that I don't like. So if I own a company and you know, they make $100 and you know, my earnings, right, as an investor is $30, but then they take 29 of those dollars and go spend it on a data center that earns them no money, I'm not going to be happy. I'm going to sell that stock and go find another one where they treat me better. That's how investors should operate. And according to the software companies, that's exactly how they're operating, because software stocks are still in the toilet. So I want you to think about when you naturally react to big tech by throwing it all in big tech and assuming it's just going to go to the moon. That's not a safe assumption. I'm not saying it's not true. I'm just saying it's not a safe assumption anymore. Things have changed and people's reactions have not. Now, the last two charts I want to share is this. It's I saw this and I had to share it because it just made me laugh. This is not news to me, but it's news to a lot of people. So back when I started, there was a good book I read in 2001 called Full of Bull. And the guy who wrote it was one of the best institutional researchers on Wall Street, like many years in a row. Like he won awards, very storied. And when he retired, he wrote this book called Full of Bull. And it talks about the bias of the financial system, where you have these research companies that write favorable research for companies who then turn around and give them investment banking business because of their favorable research. So how is that unbiased? It's not, right? Back then, it was a big deal that this is disclosed because people were just like, no, I believe them. Like, okay, whatever, they're bullshit. It's just the way it is. I get it. Like people don't like it. They want to separate it, whatever. I just don't trust the research, so I don't use it. But for a lot of people, that was a shocker. Now, look at this. There's another game that Wall Street plays with you, which is hide the earnings, right? And so typically what they do is they'll give an estimate of what they expect next quarter's earnings to be. So let's say this quarter it's $1 a share. Now let's say next quarter it's going to be $1.25. So we're going to grow 25% in the next quarter. Great. All right, the stock goes up, everyone's happy. And then let's say they report earnings. Actually, it went up 50%. Well, the stock keeps going higher and goes to the moon. Everyone's thrilled. Well, if everyone knew you were going to, go up 25%, you went up 50, well, that's a shocker. The problem is what typically happens is you earn $1 a share and Wall Street says, oh, earnings are going to be tough next quarter. It's going to be real tough. We're only going to earn $1.10, and then it comes out with like $1.25 and everyone's like, oh my God, you did great. Well, the expectation was always $1.25. They just told you it was $1.10. So they could walk over that bar a lot easier than if it was higher. So they lower the bar and then they walk over it and they're like, look at us, we won. It's like playing a game. It's like a professional athlete playing against somebody who's in Little League. You don't expect the Little Leaguer to win. It's a real easy win for them. And that's what Wall Street's doing, is they're setting themselves up for like an easy win. So then when they win, they're like, wow, we're great. Well, unfortunately, the whole street's doing this because if you look at this, the reported earnings so far, and only 10% has been reported, by the way, but out of the 10% that's been recorded, 92% have beat earnings. 92% of the companies got the memo and said, hey, we beat the low bar that we put out there for you to jump over. Look at us. We're awesome. I don't know what that 8%'s doing. Maybe they're really screwed up. But anyway, and the surprise upside was a little less than 11%. So they basically lowered it by 11%, said, look at us, we did great. And then the stock shut up. So that's a game that Wall Street plays. Unfortunately, what typically happens is when everybody gets the game, they stop paying attention. And they stop reading the research, they stop paying attention, it stops being a thing. Here's what starts happening. They go to prediction markets. Kalshi and I forget the name of the other one, but they go to the prediction markets. Now, if you go to the prediction markets, I would wager this is a much better estimate of where things are going because you have people betting real money on the outcome. I'm not saying it's certain because I could go in there and put $1 million down and say, hey, it's going to do this. And everyone's going to be like, oh my God, big money's going in. Let me do that. And then go, I mean, you can game these. But my point is when you look at this, I would say the prediction markets are more spot on than Wall Street because people are putting their actual real money on a win. And these are people who, more likely than not, when they have their real money, they're actually saying, all right, I know something and I think this is going to do A, B, C, and D. So, will Blackstone beat quarterly earnings? 26% chance, no. Or 26% chance, yes. So, 74% chance of no. Okay, well, that's good to know. It doesn't say exactly what it'll be, but it says it won't beat the estimates that they put out there. General Dynamics, 92% chance that it will be, right? Honeywell, 94%. Microsoft, 94%. Meta, 92% they're going to be. Well, my guess for Microsoft and Meta is they set themselves a real low bar. Now, GE was one of the originators of this, not the only one. Microsoft did this in the 90s too, where GE for it was 10 years in a row, always beat earnings every single time because they would manage their earnings. So they would not only try to streamline it so it's predictable, but they would also manage Wall Street's expectations. So they always managed to beat, it always make them look good. So people are like, oh, they keep doing well. And they made them feel good. And that's a positive reinforcement loop, which caused people to want to put more money into GE. So keep that in mind when you're looking at earnings season. Next week is going to be a big week for earnings. We have, just real quick, and then I'll give it back to Doug. So next week we have, see if I can, here we go. Here's what we got next week. Huge week. We've got for big companies, we've got Domino's, Verizon, we've got Visa, Coca-Cola, Novartis, T-Mobile, S&P Global. We got Waste Management. We got BP, Spotify, Starbucks, Microsoft, Meta, AbbVie, we got Santander, we got ADP, UBS, Qualcomm, Alphabet, Apple, Amazon, Lilly, MasterCard, Caterpillar, Merck, Amgen, ConocoPhillips, Stryker, Bristol Myers Squibb, you got Chevron, ExxonMobil, you got Linde, you got it's the most action-packed week of the earnings season, right? It typically is. You got a lot of the biggies and some of the biggest ones in their sectors. So next week is going to be a really interesting week for the markets. I'm not sure I'd be betting on this. I think there's so much thrown into the mix, but you want to be aware that's coming. So the markets, I suspect, are going to be just as volatile as this week. This week, we had a lot of big wins and a lot of big losses. I don't see any semis in here that I can think of. Maybe there's one, but semis have been doing well, but the rest of the market less so. So it'll be an interesting week. I'm going to be sitting here with my popcorn, just watching the the markets go all over the place. So Doug, wrap it up here for us. Final thoughts.
Yeah, sorry. So we just got some other data this week that I just wanted to share really quickly. And what it means is, has a couple of things that are going right now. And my computer is, of course, freezing up on me a little bit. So give me a second here to get it to reset so I can actually get you the data of what I was trying to read. But what we are starting to see is that this chart, which, by the way, if I can't say if it's sharing, Kirk, but it is a very boring chart. But what does this mean? What it means is that this is what we're seeing in terms of asset and liabilities of commercial banks in the United States. There's been a lot of talk about what's going on in the lending markets. I just saw another building in Minneapolis that sold a couple years ago. The mortgage lender took over the books of this on a foreclosure that of a building that had, again, was in a couple $100 million building. The lender took it over several years ago and basically took it over for about 40 million. It has now been repriced and resold, I think 2 or 3 times on credit sales and auctions. And this couple $100 million building just sold for about 1.7 million. It is just awful. Okay, so what is again? So you're hearing a lot of these stories, and that, of course, can lead to some fear, positivity, depending on how you read it. Credit growth did pick up. Okay, this is something, so there's some bullish and bearish data that's on this chart right now that I think is really important to know. Credit growth did pick up, then it cooled. From December into early 2026, bank credit clearly accelerated. It went from low single-digit growth at the end of last year to double-digit territory in February, but then March, the pace pulled back again. So yes, the good news is credit is still growing, but it's no longer accelerating. Business borrowing is what's driving the system. The biggest driver of that growth is commercial and industrial loans. Those surged sharply in February and remained elevated in March. And that tells you businesses were actively borrowing. But there's a little bit you have to read into this. It's likely to manage costs, refinance, or lock-in financing. So could be bullish, could be bearish. But most importantly, that surge has already started to level off. Consumer credit is active, but it's not stable. On the consumer side, credit is still expanding, but it isn't a smooth trend. There was a dip in February, then a bounce in March, and that's not steady demand. That's more reactive behavior. We did see that there was a significant stall completely on the housing lending side. We did see a big spike recently in the last week or so of applications, but again, mortgage rates did dip. So a lot of that could be people just jumping in on a temporary dip in mortgage rates. They've already gone back up. So consumers are still spending, but they're adjusting based on conditions. Real estate lending overall is a weak spot. It's clearly lagging. Growth in total real estate loans has slowed to near zero. Residential lending actually turned negative in March before this recent uptick. It's a meaningful shift. Housing's not contributing to credit growth right now. It's actually a major drag on it. Home equity still holding up. One area that we're still seeing growing is home equity lending, and that suggests, no surprise to probably many people aren't moving. They're not taking new mortgages. They're tapping into existing equity instead. The other thing that's a positive is deposits are stabilizing. On the funding side, deposits have picked up into early 2026. And that is a sign that liquidity in the banking system, which we have talked about, Kirk, has been a real challenge, especially with a lot of these unrealized losses that banks are facing. Liquidity in the banking system is actually stabilizing right now compared to earlier periods. Borrowings all pulled back after a spike. So at the same time, banks sharply reduced their borrowings in March after elevated levels earlier this year. So they've leaned on external funding earlier, then they step back. What does this all mean? When you put it together, you don't really get a simple growth story. You get a mixed picture. Businesses are borrowing more, consumers are active but uneven, housing is weakening, banks are adjusting how they find themselves. That is not broad expansion. It is selective and shifting activity inside the system. Key takeaway is that credit is still growing, but it's concentrated and less consistent than it looks on the surface. And when growth depends on just a few areas, it becomes sensitive to change. So what's the bull case? Well, the bull case is credit is still expanding. Loans are growing, not contracting. That matters. Credit contraction is a leading indicator into triggering recessions. So right now, the system, fortunately, still functioning and extending credit. Businesses are borrowing aggressively. C&I loans are surged and remain elevated. So from a bullish standpoint, companies are still investing and still operating. There's no broad corporate freeze. deposit stabilizing. That means that banking system liquidity is improving, which means less immediate systemic stress, so it can weather storms. And no broad credit breakdown means that the consumer credit is still growing. No collapse in lending overall. This is not a credit crisis setup like some people want to compare the possibilities of a 2008. The economy still has access to credit, and that's what keeps the cycle alive. But let's look at some concerning bear cases. The growth is narrow. It's not broad-based. It's driven mainly by business loans. Housing is weak, continues to be. Consumers inconsistent. Healthy expansions are broad. They are not concentrated. So this is, the fact that it is mainly business loans, that's not a positive. Housing has turned negative. Residential lending contracting until this recent spike on lower rates. And that's one of the biggest economic multipliers. So if we continue to have this stalling in the residential market, that continues to pose a lot of headwinds to the economy, because when housing weakens, the economy loses a key engine. Business borrowing may actually be defensive. So I told you the bullish side of it, but on the bearish side of it, it could be, the C&I spike could be refinancing at higher rates. It could be businesses borrowing not to expand, but just to cover costs. And it could be pulling forward borrowing. That is not necessarily growth investment. So again, not all borrowing is bullish. Some of it is survival. Credit behavior, volatile, not confident demand, reactive, not stable. And lastly, momentum is already starting to show after the February peak. March was a pullback. Again, could be lagging issues with what's going on in the war. So we may have already seen the high watermark for credit growth. We'll just have to see. At the end of the day, it's neither bullish or bearish. This is late cycle behavior. And that data doesn't show that a booming economy. It doesn't show a collapsing one. It does show sign for caution. Late cycle is an area in which it's time to start getting your financial house in order and trying to keep it that way from the things that can hit. Late cycle economy has credit still growing, but concentrated. Business borrowing, but maybe defensive. Consumers active but inconsistent. And housing is starting to weaken from being flat. That's what traditional late cycle looks like. So continue to look at, we may be continue seeing slower growth going forward. We may see more volatility, as you mentioned, Kurt, more sensitivity to shocks because the growth is not broad-based, and the housing drag is going to continue to maintain unless rates fall meaningfully. So, ultimately, I think it just bodes to a time where, as we have seen a lot of conflicting data that showed maybe we're late cycle this, but early cycle this, we're starting to see more data that's showing all of the main areas of economic data showing late cycle. And so as we wrap up today, let's bring this back to real life for a second. We spent the last hour talking about markets, credit, volatility, late cycle behavior, earnings season, revenue season reporting. But here's where actually, hits home. We work with families right now looking at schools with, $50,000, $60,000, $70,000 cost of attendance. I talked to my son the other night. It was interesting. And I said, look, there's a family we just talked to. They're going to get, potentially only $10,000 a year in cost for college. And my son, who's 13, looked at me and said, Dad, that's expensive. I said, yeah. I said, what do you mean? He said, well, that's $40,000 for college. I said, yeah. But I'm going to let you know that a lot of people are paying 40, 50, 60, 70,000 for 1 year. So 40 over 4 years, college is going to be expensive. But when you start adding that up and you start seeing that it could be $200,000 over 4 years, yeah, on paper, that's insane. But here's where you can start to unpack it. If you're looking at, if we talk about credit, college loans, right? If you have if you've got a $72,000 cost of attendance, but this is a real world example of a family that we worked with, a $42,000 executive scholarship, plus an $8,000 music scholarship. And by the way, affluent families aren't filing FAFSA. They got a $2,000 scholarship just for filing FAFSA. So it pays to file FAFSA. and they got another $2,000 referral credit. Oh, by the way, their parents could refer the child. So the referral credit certainly didn't take some outside party. They could refer themselves. That was $54,000 right off the top of that $72,000 cost of attendance, and that didn't even touch local or department level scholarships left yet. So all of a sudden, that $72,000 school isn't $72,000. That's the point I'm trying to make, because just like the markets, what you see on the surface is rarely the full story. The markets look strong, but underneath, credit is shifting and shaky. Economy looks stable, but housing is weakening. College looks unaffordable, but pricing is layered and negotiable. If you don't understand that structure, you're going to make decisions in all areas, investing, in cash flow, in retirement, in college, all on the wrong numbers. At Mergent Advisors, that's what we do. Map everything: income, assets, liabilities, taxes, college funding, the strategies, tax strategies, saving, spending, retirement income, all of it, so you can see what it actually costs, what risks actually exist, and where the real opportunities are. Because whether it's markets or college, the biggest mistakes happen when you react to the headline instead of understanding the system behind it, but also when you jump ahead and do things without the knowledge necessary to make sure that you're making smart decisions with your money. So if you're looking at a $70,000 school and thinking, there is no way, or you're looking at this market and thinking this feels off, you're probably right. You just don't have the full picture yet. And if you want clarity around it, college, retirement, or your full financial life and how it all goes together, visit us at mergentadvisors.net. That's MERGENT, mergentadvisors.net. Start the conversation, because better decisions don't come from better guesses. They come from better understanding. So we'll see you next time.
Awesome. Well, thanks for joining us, Doug. And that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one. But as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.